So, good day. Our lesson for today is cash flow statement. So, cash flow statement is the report of the inflow and outflow of cash or the movement of cash in a business or in an investment. For example, a business needs cash flow in order to pay its employee wages, the taxes, the government taxes, and of course the building or the rent. So it's also essential, for example, for the employee, it is essential to have inflow or cash inflow from salary to pay monthly expenses, which are electric, food, credit card, and so be able to also to put some in their savings. So therefore, if the cash inflow is better or has a higher number rather than cash outflow, then it would be an indication of a good business feasibility. So now let's take our journey on what cash flow is. So what is a cash flow statement? A cash flow statement allow investor to understand how the company's operation are running, where its money is coming from, and how money is being spent. So usually, cash flow are the information that would tell us from the balance sheet and the income statement how this balance sheet and income statement movement of cash from one of the accounts to another. Okay? So there are three components, which is the operating activities. So normally the operating activities are normally the payment or the cash flow within the operation or within the operating cycle of the entity. For example, the purchasing of goods, then paying the creditors or the trade creditor, then the collections, paying of taxes and the wages or anything related to the operation. While investing activities are usually those that are for investment or the purchase of bigger or long-term assets such as land, investment properties, fixtures and furnitures, and also the selling of these. So proceeds from the sale of the long-term asset as well as the dividend. Because when we invest, we receive dividends. So that would go now to investing. Whereas financing is the sourcing of funds. Normally, the main source of fund are those that are from the capital. So any payment that pertains to the capital, such as dividend from payment of the capital, would also be financing. And some of the borrowings or the payment of mortgages. So these are the financing activities. So what is the operating activities? As we said, this include any spending or sources of cash that involve on the day-to-day business activity because it's the operations. So it's the supplies, the wages, the purchases, the ads. So these are operating. Anything that are related to the operation or to the day-to-day business activity. Example, the cash receipts from sale of goods and rendering of services, cash payment to suppliers, and services because take note these are all within the operating cycle and then cash payment to and on behalf of the employee. So if you would see the three examples are normally on a day-to-day activity or related to the day-to-day business transactions. And lastly, payment and receipt from customer held on for dealing or trading purposes. Okay? So what is now investing? So investing is a means for us to grow our money. So these are cash used to purchase the non-current asset or long-term asset that will be deliver value in the future or current period. So meaning investing are usually if you buy something normally at the as the time goes by, the money that you have invested to that one usually have its present value and decreases over time as well as the price of this product. So that's why it was called also investing. So example of these are cash payment to acquire property, plant and equipment, intangible and long-term assets. So these are our long-term or non-current assets. So payment to the acquired equity and debt instrument of other entity because this one would usually earn as dividend. So these are the trading in stock but you held it for long term. Next, we also have the financing. So financing, these are generated on the or to spend for financing activity. Net cash flow involved in the funding or the operation of the business. So usually financing is from the world itself. Financing, it's the sourcing of fund. So where do we get the fund in order for us to finance our business? So these are proceeds from the issuing of shares or other equity instrument or short the capital investment of the owner. And then we also have cash payment to owner to acquire or redeem equity shares. So yung mga treasury bills, these are our treasury bills that we had to reacquire. And then proceed from issuing of debentures, loan, bonds, mortgage, and other term or long-term borrowing. So these are pertain to our creditor. The first two pertain to our owner or to our stockholders' equity. So if you would see from our asset counterpart, this financing activity are what we call the sources from our investors and the sources from our creditor. Okay? So how to report cash flow from operating activity? An entity usually report this using two methods, the direct method and the indirect method. So the direct method are usually the real how the cash really goes in and out, like the purchase of material, the payment of creditor. So you account for that. And normally direct method is the one that is being used under the IFRS. Now, we also have the indirect method, but the indirect method would usually show you the increase and decrease over the assets, liabilities, equity of the entity. Okay? So, example. So, let's see. These are the pro forma entry for our direct method. So, if you would see, these are the operating, which are normally proceeds from sales of goods, collections of income and revenue, collections of receivables. So, these are your usual trading or within the operating cycle. And then the outflow is payment of goods and services and payment of taxes and deposits and advances. So these are also within the operating because these are still related to the usual activity. So we have then the net cash flow provided by the operating. So if it's negative, it's usually how much or we exceeded the amount of inflow. Next, we have from our cash flow from financing. This is also the pro forma entry. So if you would see, it's proceeds from sale or disposal of long-term assets, receipt of interest or cash dividend from our investment bond. Take note because the cash dividend we receive from our our equity or forgiven to our stockholders is will be on the financing. So these are this receipt from interest and cash dividend are usually from our investments. And then proceed from matured investment and collection of long-term loans. Next, we also have cash outflow. So we have the purchase of long-term, the payment of loans and receivable, and the payment and advances and deposits for long-term activities. Okay? So we have the net cash provided and in now the financing. So the financing, usually these are proceeds from the issuance of stocks, proceeds from long-term loan, and then the cash outflow would still be the payment of liabilities and bonds. And the cash dividend, take note this one is payment because this pertain to our stockholders' equity. Then we add up our beginning and then the exchange rate would be different and then the cash equivalent beginning to be add up so that we will be able to come up with our cash and cash equivalent at the end of the period. Okay, so indirect method is this one because it's usually the increase or decrease only. So except for the depreciation and amortization because there is no real cash outflow for this two. Because the cash outflow would normally start at the beginning. And so as the increase and impairment of losses, gains, and losses, and so on and so forth. Okay? So let's try. From our, this one was lifted from our adjusted trial balance and so with the balance sheet. So we see, as I've told you, the cash flow would reconcile the income statement account as well as the balance sheet. So let's see. So we have now cash inflow from operating activities. So we have cash collection from sales. Remember our sales is 175, but we have receivable of how much? 75,000. Okay, 75,000. So we have 100,000 collection from sales. We also have collection from unearned services because money was given to us. So we have now total cash inflow from operating of 105,000. Then we pay our employees 40,000. If you check, it's 50,000. But remember, we still have the unpaid, which is 10,000. So we deduct because there's no cash outflow in it for that 10,000. So we only have 40,000. The payment of rent, 30,000. The payment of supply, 5,000 because there's still a prepayment of 2,000 supplies. And then payments of utilities, 34,000. Then we have now the total cash outflow of 109,000. So net cash flow from operating activities, negative 4,000. So we overspend for our operating activities. So we also have for investing, we only have one because we only have one long-term asset, which is computer, 25,000. We didn't account for the depreciation because the depreciation is for the indirect. So we have now 25,000. So from financing, we only have one, which is the investment from our owner, 100,000, and the cash outflow is the withdrawal from our owner, 10,000. So we have net cash inflow from financing, 90,000. So we have an decrease cash flow, cash and cash equivalent of 61,000. We don't have any beginning because it's only start of the operation. So if you would check, the balance of cash at the balance sheet is also 61,000. Okay? So if you have any comment with this one, just comment below, okay? So for foreign cash flow, usually for foreign cash flow or cash flow arising from foreign transactions shall be recorded in the entity's functional currency. I already explained functional currency in our previous video, which states that functional currency are the currency which mandated most of the transactions of the business. By applying the foreign currency amount at the exchange rate between the functional currency and the foreign currency at the date of cash flow. For example, here most BPOs are from from the US, for example. So the functional currency are normally US, but payments are for the salaries would normally, for the taxes, would normally in peso. So that would now be converted into the current exchange rate under its functional currency. Okay? So next, the effect of the exchange rate on cash and cash equivalent are held or due in the foreign currency is reported in the statement of cash flow to reconcile cash and cash equivalent at the beginning and at the end of the period. So if you would see, we still have one line item that state in there the foreign currency cash flow or the net foreign currency cash flow because those still have some translation gain sometimes. Then the amount is presented separately from the different cash flow. So, yun nasa baba. Okay? So, thank you for watching this video. Hope you learned something. And if you like this, please reach out. Help me reach out for more people by hitting the subscribe button. And God bless you. Bye.